Right now, at this very moment, there are millions of seniors across the United Kingdom who are sitting completely unaware of a rule change that has the potential to directly affect the money sitting in their bank accounts. And I want you to stop whatever you are doing, because what I am about to share with you is something that legal professionals, financial advisors, and benefit specialists are urging every single pension recipient in this country to understand before it is too late. This is not fear-mongering. This is not clickbait. This is a genuine, urgent conversation that needs to happen, and it needs to happen right now. So let us begin from the very beginning, because context matters enormously here. If you are a UK senior who receives any form of pension, whether that is your state pension, pension credit, attendance allowance, or any other form of benefit payments that land in your bank account on a regular basis, then the new £250 bank rule changes coming into effect in 2026 are something that could change your financial life in ways you absolutely need to prepare for. The question is not whether this affects you. The question is whether you are going to be ready when it does. Let us talk about what is actually happening here, because there is a lot of confusion swirling around this topic, and that confusion is dangerous for seniors who depend on their payments to cover essential living costs every single week and every single month. For years, the benefits system in the United Kingdom has operated under what many people assumed were permanent, unchanging rules about how much money you are allowed to hold in a bank account while still qualifying for means-tested benefits. Pension credit, in particular, has long been governed by savings rules that can reduce or even eliminate your entitlement once your capital savings cross a certain threshold. But what is changing in 2026, and what legal professionals are now urgently drawing attention to, involves the interaction between these savings thresholds, the way banks are now required to report account balances to the Department for Work and Pensions, and the impact this could have on pension recipients who may not even realise they are sitting on savings that could be considered when calculating their benefit entitlements. Here is what you absolutely must understand. The £250 rule is not a new savings limit in the traditional sense. What it refers to is a threshold below which certain capital assessments have historically been disregarded, and the critical change coming in 2026 relates to how automated banking data sharing between financial institutions and the DWP is now being used to cross-reference what claimants have declared with what their bank accounts actually show. This means that seniors who have perhaps accumulated small amounts of savings over time, who perhaps received a gift from a family member, who perhaps had a lump sum payment land in their account for any number of perfectly legitimate reasons, could find themselves subjected to benefit reassessments, overpayment notices, and in some cases, demands for repayment of benefits that have already been spent on food, heating, and basic living costs. And this is where lawyers are raising their voices the loudest. Legal professionals who specialize in benefits law are warning that the 2026 changes create a situation where the most vulnerable seniors in our society, people who have worked their entire lives, people who have paid into the system for decades, people who are simply trying to survive in an era of rising costs and shrinking purchasing power, could find themselves caught in a bureaucratic trap that they had no idea was closing around them. Let me be very specific about the kinds of situations that are now causing the greatest concern among legal experts. First, there are seniors who receive pension credit and who may have small savings accounts that they have not fully disclosed, not out of dishonesty, but because they genuinely did not understand which savings count and which do not. Under the rules governing pension credit, capital above £10,000 begins to affect your entitlement. Capital above £16,000 can disqualify you entirely from guarantee pension credit. These are thresholds that have been in place for some time, but what is changing is the enforcement mechanism. The automated data sharing that comes into force more robustly from 2026 means that the DWP will have far more real-time visibility into what is sitting in your accounts than they have ever had before. And if there is a discrepancy between what you have declared and what the bank data shows, even an innocent discrepancy caused by a misunderstanding of the rules, you could receive a letter that ruins your week, your month, or potentially your year. Second, there are seniors who have received one-off payments that they were not expecting. Perhaps you received a compensation payment. Perhaps a family member passed away and you received a small inheritance. Perhaps you sold a piece of furniture or a car. Under the capital rules for means-tested benefits, these kinds of payments can affect your entitlement in ways that are complex, counterintuitive, and deeply unfair if you are not properly informed. Legal experts are warning that thousands of seniors are going to be blindsided by reassessments triggered by these kinds of payments landing in their accounts in 2026 and beyond, and that the consequences, if left unchallenged, could include demands for repayment of thousands of pounds. Third, and this is perhaps the most emotionally difficult element of this entire conversation, there are seniors who have been deliberately and carefully managing their finances in ways they believed were entirely legal and appropriate, only to find that the new reporting mechanisms are flagging their accounts for review. This is not about fraud. This is not about dishonesty. This is about a system that is becoming more automated, more data-driven, and inevitably more prone to generating false positives that create enormous stress and financial anxiety for people who can least afford to deal with it. So what do the lawyers actually recommend? This is the part of the conversation that matters most, because it is one thing to understand the problem and quite another to know what to do about it. The first and most important piece of advice coming from legal professionals right now is to conduct a thorough, honest, and complete review of every single bank account you hold, every savings account, every premium bond, every ISA, every cash held in any form, and to understand how those amounts interact with your current benefit entitlements. If you receive pension credit, you need to know your capital total. You need to know whether it is above £10,000, because if it is, your pension credit should already be reduced, and if it is not being reduced, that means you may be receiving more than you are entitled to, which will eventually need to be repaid. If your total capital is approaching £16,000, you need to urgently seek advice about your options, because crossing that threshold means losing pension credit entirely, which for many seniors would represent a loss of hundreds of pounds every single month. The second piece of advice is to make sure that every single penny of income and capital that you hold has been properly reported to the DWP. This sounds obvious, but legal experts stress that the reporting requirements are more complex than most people realize. There is a difference between income and capital. There is a difference between how an annuity is treated and how a lump sum is treated. There are rules about what counts as deprivation of capital, meaning that you cannot simply give money away to a family member in order to reduce your declared capital, because the DWP has rules specifically designed to address that situation, and if they believe you have deliberately deprived yourself of capital in order to maintain your benefit entitlement, they can treat you as if you still hold that money. The third piece of advice, and this one is absolutely critical, is to understand your appeal rights. If you receive a letter from the DWP telling you that your benefits are being reduced, suspended, or that you owe money back, you have the right to challenge that decision. You have the right to request a mandatory reconsideration. You have the right to appeal to an independent tribunal. And legal professionals stress that these rights are enormously valuable, that the DWP does make mistakes, that automated systems do generate errors, and that seniors who simply accept the first decision they receive without challenging it are often leaving money on the table that they are fully entitled to. Now let us talk about the broader benefits picture, because the £250 bank rule sits within a much larger ecosystem of financial support that UK seniors are entitled to, and the tragedy is that many of them are not claiming everything they should be. Pension credit is one of the most underclaimed benefits in the entire United Kingdom. Estimates consistently suggest that somewhere between a third and a half of all seniors who are eligible for pension credit are not claiming it. The reasons for this are complex and often heartbreaking. Some seniors feel that claiming benefits carries a stigma. Some seniors believe they will not qualify. Some seniors have tried to apply in the past and found the process so confusing and demoralizing that they gave up. And some seniors simply do not know that pension credit exists or that they might be entitled to it. But here is what you need to understand about pension credit in 2026. If you are over state pension age and your weekly income falls below a certain threshold, which for a single person is currently in the region of £218 per week and for couples is higher, then you may be entitled to guarantee pension credit that tops up your income to that level. And receiving pension credit is not just about that top-up payment. Receiving pension credit acts as a gateway to a whole range of other entitlements that can be worth thousands of pounds every single year. If you receive pension credit, you may also be entitled to full housing benefit if you rent your home. You may be entitled to a full council tax reduction. You may be entitled to free NHS dental treatment. You may be entitled to free sight tests and help with the cost of glasses. You may be entitled to the Warm Home Discount, which gives you money off your energy bills. You may be entitled to a free TV license if you are over 75. The cumulative value of all of these entitlements for a senior who is currently not claiming pension credit but who qualifies for it can easily exceed several £1,000s every single year. And yet, because of the complexity of the system, because of the stigma that still unfortunately surrounds benefit claims in some communities, because of the sheer bureaucratic difficulty of navigating the application process, hundreds of thousands of seniors in this country are going without money that is rightfully theirs. Money that was built into the system specifically to support them. Money that they have in many cases spent their entire working lives contributing to through taxes and national insurance contributions. The 2026 changes make this situation more urgent, not less. Because as the data sharing mechanisms between banks and the DWP become more sophisticated, the window for seniors to get their affairs in order, to make sure their declarations are accurate and complete, to make sure they are claiming everything they are entitled to, is beginning to close. Legal professionals are specifically warning seniors to be alert to the following situations. If you have a joint bank account with a spouse or partner, you need to understand that the capital in that account is typically assessed as belonging equally to both of you for benefit calculation purposes. If you have money held in a trust, you need to understand how that trust is treated under benefits rules, because depending on the structure of the trust, it may or may not be counted as your capital. If you have recently moved house and have received a property sale payment, you need to understand the rules about how property proceeds are treated in the period immediately after a sale, because there are specific provisions that apply during what is called a period of disregard. And if you have received any kind of compensation payment, whether from a personal injury claim, from a missold financial product, from a housing dispute, or from any other source, you need to urgently seek advice about whether and how that payment affects your benefit entitlements, because the rules in this area are genuinely complex and the consequences of getting them wrong can be severe. The message that lawyers and benefit specialists are trying to get through to every senior in this country right now is simple, and it is this. Do not wait for a letter from the DWP to find out that something has gone wrong. Do not assume that because your benefits have been paid without interruption for years, they will continue to be paid without interruption forever. Do not assume that the system will automatically identify everything you are entitled to and ensure you receive it. The system does not work that way. The system requires you to be proactive, to be informed, and to take responsibility for making sure your claims are accurate, complete, and up to date. The good news is that there is help available. Citizens Advice, which has offices across the country and a national helpline, offers free, confidential advice on benefits and has advisors who specialize in exactly these kinds of complex situations. Age UK, the national charity for older people, has a benefits helpline and an online benefits calculator that can give you a quick indication of what you might be entitled to. Many local councils have welfare rights teams that offer free advice specifically to seniors navigating the benefits system. And there are solicitors and legal aid organizations that specialize in benefits law and who can represent you if you need to challenge a DWP decision. The cost of not acting, of simply hoping that things will sort themselves out, of putting this conversation off until later, is potentially enormous. And the cost of acting, of spending an hour on the phone with Citizens Advice, of using an online benefits calculator, of gathering together your bank statements and making sure your declarations are accurate, is nothing. It is your time. That is all. So here is what I am asking you to do right now, today, not tomorrow, not next week. I am asking you to take action. Check your savings balances. Review what you have declared to the DWP. Make sure you are claiming every benefit and every entitlement that you are eligible for. And if you have any doubt whatsoever about whether your affairs are in order, pick up the phone and speak to someone who can help you. Because the seniors of this country deserve to receive every penny they are entitled to. They deserve to live their lives without the fear of unexpected letters, unexpected demands, and unexpected financial shocks. And the best way to make sure that happens is to be informed, to be prepared, and to act now, while there is still time to make a difference. The £250 bank rule change in 2026 is not the end of the world. But it is a wake-up call. And the question is whether you are going to hear it. Subscribe and turn on notifications so you never miss a benefits update that could put hundreds of pounds back in your pocket.